Now, Aisha spoke with TV Narendran, the CEO and MD of Tata Steel, who believes that the company is set to achieve its expansion plans, projects 2 million tons higher production in India, and expects to maintain a net debt to EBITDA ratio between 2.3 and 2.5% range ahead. Listen in.
India's delivered well. I think we continue to obviously focus on growth in India, and we've just announced some expansion plans for that. As far as Europe is concerned, if you look at UK, it's progressing towards break-even. I mean, every quarter for the last few quarters, we've reduced the losses. I know that's not something to be very proud of, but at least we're moving in the right direction. We are still EBITDA negative, but we were 48 million, I think, last quarter, and we are about 27 million pounds negative EBITDA this quarter. And Q2 will be better than Q1, will not be positive, but pretty close to break even. So I think UK is moving in the right direction, maybe a bit slower than we thought, but we've been helped by some of the trade actions that have been taken recently there.
Would you have a timeline to when Europe is going to break even?
So I think by the end of, certainly this quarter, if you see Q2 between Netherlands and UK will be positive EBITDA, both put together. Okay, because Netherlands is going to do better in Q2 than in Q1. We had some one-off issues in Q1. We are hopefully sorting that out in Q2. So between the two, we will be positive EBITDA in Q2. And UK on a standalone basis, we expect to be positive EBITDA by the last quarter of this year.
Okay. What about coking coal costs? Because they've risen sharply for you, both in India as well as Netherlands, right, in the quarter gone by. And that's clearly weighed in on your margins. Are you seeing any early signs of coking coal prices stabilizing, or should we brace ourselves for more pressure?
I think coking coal, the problem is always that it's a very liquid market, so it can move very rapidly in either direction. We are guiding Q2 to be about $5 per ton higher in consumption than Q1 in India, and about $10 per ton higher in consumption cost in Netherlands Q2 compared to Q1. So we are seeing it stabilizing. We are not seeing any drop, but hopefully we will see a drop maybe in Q3. But just now, it peaked at $240 coking coal cost. Now it's come down to maybe $230.
Domestic realizations, they've risen sharply, though, on a sequential basis as well. Setting aside the usual monsoon-led seasonality, do you expect this upward momentum in steel prices to continue through the rest of the year?
So if you look at the prices now, flat products is a bit more resilient than long, because flats is obviously helped by the strong growth in auto sector. So we are seeing flat prices more sustainable. Longs, like you said, is impacted by monsoon, and this is a weak quarter for construction industry. So we are seeing long prices drop. So both put together, we are guiding Q2 to be about 1,500 rupees per ton lower than Q1 as far as realizations are concerned.
And your India production volumes, they were up a good 10% year on year. I guess higher output at Jamshedpur as well as Kalinganagar also contributed. What's the volume growth outlook now for India, specifically for the full year?
For the full year, we expect it to be about 2 million tons higher than last year, partly because last year we had a blast furnace relining in Jamshedpur. So obviously that's not there this year, and that gives us additional volumes out of Jamshedpur compared to last year. And Kalinganagar ramp-up is pretty much complete. We have a Ludhiana plant which we've just started, and you will see better numbers quarter on quarter. So we are actually expecting Q2 to be better than Q1, and for the full year, like I said, will be about 2 million higher than the previous year.
You also approved a Capex for a 4.8 million ton per annum expansion at NINL. Walk me through the Capex plan, phasing, and the expected timeline for this expansion.
So the expansion should take about 4 years. 48 months is what we are forecasting, because it's a big project, and we are building in a site which already has an operating steel plant. So we just need to be a bit conscious about that. But it's an important journey for us from a long products point of view. And the entire Kalinganagar complex, with the flat product complex and the long product complex together, has a potential to go to about 25 million tons. So this will take the Kalinganagar footprint from 8 million to 13, because we have an 8 million ton flat products complex there. The Capex will be spent over, while the project will finish in 4 years, the entire Capex outflow will probably happen over 5-6 years, because when you're building plants like this, oftentimes the final payments are made after you run the performance guarantee tests and things like that. So we are comfortable that this will be taken care of from our internal generation. So there's no problem with that.
On the UK transformation, National Grid had earlier flagged a potential delay. Tell me, where do things stand as of now? What's the revised schedule? And how confident are you about hitting it?
So it's clear that we will not have the power when the plant is ready, right? And they had indicated to us that it's a 12 to 18 month delay. We are now more thinking that will be 12 months and 18 months. We are also working very closely with them to see that even if you don't have the full supply, can we get one line? So the plan that we have is as soon as the plant is ready, we'll start doing all the cold trials, keep it ready. And if we can get one line, we can, start testing some parts of the plant, etc. So there's a lot of work going on with the National Grid. Firstly, to see can they do it faster. Secondly, with what they have ready, can we at least do some work in the plant so that we are ready to ramp up quickly. So I think we will have the plant ready by 2028, and sometime in 29 we'll start production when we have all the power supply that we need.
Your net debt rose about 5% sequentially as of June end. Given the Capex commitments on the table, which is the UK transformation as well as Neelachal Ispat, should we expect that number to climb further before it comes down?
Not necessarily, because, honestly, most of this increase in Q1 has been because of working capital. Firstly, we've had some disruptions like the direct strip plant in Netherlands, so we had to buy some slabs for Netherlands. Secondly, in Q4, normally there's a cleanup of a lot of inventory, so you're running below optimal levels of inventory in many plants and you stock up a bit in Q1. So the increase in net debt in this quarter is largely because of working capital. So some of that will go away in the next few months. So we don't expect the net debt to go up, based on the Capex that we have planned. I think we will stay well within our plan. And if you see, the net debt to EBITDA is about 2.3 just now. So we wanted to stay in the 2.3 to 2.5 range, and that's very comfortable, we feel, for a company like us at our phase of growth.